Hey, Alex again. This is chapter 4 of Accounting 201. This is completing the accounting cycle. Very, very important. Closing entries are now coming into effect. So let me start off with the introduction. Most of us have had to file a personal tax return at the beginning of the year. You estimate your upcoming income and decide whether you need to increase your payroll tax withholdings or perhaps pay estimated taxes. So sometimes you may need to withhold more, depending on how much you're making, or maybe you don't need to withhold as much. So during the year, you earn income and enter into tax-related transactions such as making charitable contributions. At the end of the year, your employer sends you a tax withholding information, a W-2 form. You collect the tax records needed for completing your yearly tax forms. As the next year begins, you start the cycle all over again. So businesses go through the same cycle of activities. For example, Electronics Arts Incorporated, the world's largest developer and marketer of games, begins its cycle by developing new or revised game titles. Madden NFL Football, Need for Speed, The Sims, The Lord of the Rings. These games are marketed and sold throughout the year. During the year, operating transactions of the business are recorded. For Electronics Arts, such transaction includes salaries of game developers, got to pay the developers, advertising expenditures, advertising is not cheap. Costs for producing and packaging games, you got to package them, all that stuff. When you get the game and you unwrap it, that's all got to be paid for. And game revenues. So when you buy, when you sell the game, you got to keep track of that. At the end of the year, financial statements are prepared that summarize the operating activities for the year. Electronics Arts publishes these statements on its website at investor.eea.com. Finally, before the start of the next year, the accounts are readied for recording the operations of next year. So before you start the next year, you're going to close entries and prepare for the new start of the new year. So you're a clean slate. So in chapter 1, we talked a little bit about the opening accounts. So now we're on the closing part. So now we're on the flow of accounting information. So the process of adjusting entries and preparing financial statements is one of the most important in accounting. This is where you get your most work done, and it's one of the most pivotal parts of accounting. So the adjusted trial balance verifies the total of debits equals credits. But then after we do the unadjusted trial balance, we do the adjusted entries. After the adjusted entries are done, we do the unadjusted trial balance. After we do the unadjusted trial balance, then we'll have our financial statements. We'll have our financial statements, but then we're also going to have a closing entries, and then we're going to have our post-closing trial balance. So one thing that helps some people is a worksheet, and I'll show you a example later on, but the worksheet is basically just shows the flow of how all the data goes together. Because it is true, every statement flows to one statement or the other. So let me see, we'll get to, so the income statement is prepared directly from the adjusted trial balance. So you're going to take all your accounts for the income statement, which is your revenue accounts and your expense accounts, and put them right into the income statement from the adjusted trial balance. Fees earned, so your revenue starts with the highest revenue account goes first, and then it goes to the next revenue account. So from higher to lower. And then you're going to have expenses from highest to lowest, with miscellaneous always last, no matter what the amount is. Next, you're going to have the statement of owner's equity. The first item is always the balance. So here is Alan Johnson Capital, January 1st, 2011, $39,000. And then you're going to add in your investments, if you made any investments. So if you put any more cash into the business, which will give you your total, then you're going to deduct your net loss if you had one, or if you had a net income, add that in. And then you're going to subtract your withdrawals, which will give you either an increase or decrease. If you have a decrease, it's going to bring down your equity from a higher number to a lower. If you had an increase, it's going to increase your beginning equity from a higher number to an even higher number. And then that statement flows into the balance sheet. So the balance sheet is prepared directly from the adjusted trial balance. Once again, except you're not going to have any of your revenue or expenses. Those have already been closed. The balance sheet is only assets, liabilities, and equity. And so you're going to have assets first. So you're going to have current assets and other assets. So current assets are expected to be converted to cash or sold or used up within the year or less through normal operations. Notes receivable can be current if due within a year. Property, plant, and equipment is also an asset, but it's longer term. So these assets are called fixed assets or plant assets, and they'll depreciate over a period of time. And they'll have accumulated depreciation, and we'll keep track of that. And they'll always be on the balance sheet. Okay, liabilities. Current liabilities are due within a short period of time, so within a year, and they'll be paid out of current assets. So that's the difference between current and non-current. Current liabilities include wages payable, interest payable, taxes payable, and unearned fees. Long-term liabilities won't be paid within a year, so they'll go on over a year. Typical long-term would be bonds, mortgages, mortgage note payable, mortgage payable, and usually those liabilities, mortgages especially, have a pledged security, so they're usually secured debt, and so long-term is going to take you more than a year to pay off. Not necessarily bad if you're using it to generate revenue. And then of course the last is owner's equity. So owner's equity is added to total liabilities, and this total must equal the total assets. So total assets will always equal total liabilities, total owner's equity. And so now the newest entry we're on is closing entries. Closing entries close out the temporary accounts. We don't close out the permanent. So permanent accounts are cash, accounts receivable, equipment, accumulated depreciation, accounts payable, and owner's capital. Temporary are always revenue accounts, expense accounts, stuff that we want to keep track of that changes from period to period. So to do a closing entry, it's basically a closing process where we close the books. So revenue accounts are transferred to a new account we're working with called an income summary, and expense accounts are transferred to an account called income summary. So an income summary is basically a clearing account. It's just a holding account that we'll use to keep track of if we had a gain or a loss. When we get into intermediate, you'll just close out, or into higher level accounting, we'll just close out the revenue and expense accounts directly into retained earnings. But for now, we'll use income summary. So debit each revenue account for its balance and credit income summary for the total revenue. So you debit the revenue account and credit the income summary to get rid of the income. You credit each expense account and debit income summary for the expenses. Then, if you have more revenue than expense, you'll debit income summary and credit the capital. So you actually make a gain. You'll increase your equity. If you have more expenses than revenue, you're going to debit your capital account, the owner's capital account, and credit the income summary. So either you're going to have a gain or a loss. So closing entries are recorded in the journal and are dated the last day of the accounting period. So the 31st, 30th, what have you. And so we have a flow. So All your expenses go to the income summary, all your income goes to the income summary, and that's how you're going to know if you have a gain. It's just a really good check figure. And then I was talking about this, the post-closing trial balance. It's prepared after all postings have been, after you have entered your closing entries and you post it into the ledger. You're going to do a post-closing trial balance just to make sure debits equal credits. And the post-closing isn't going to have any expenses on it or revenue, it's just going to have what's on the balance sheet. Okay, the accounting cycle. This is important. The accounting process that begins with analyzing and journalizing transactions and ends with the post-closing trial balance is called the accounting cycle. So the steps are as follows. These are the 10 important steps. Transactions are analyzed and recorded into the journal. So you record your transactions. Then you'll take those transactions, post them to the ledger, to the right accounts. You do an unadjusted trial balance. It's prepared. You do adjustment, so you gather your adjustment data, you assemble your adjustments and analyze them. Okay, this is what I need to put in. You can prepare an optional end-of-period spreadsheet, which you might have done in some assignments. It's optional. It's a good worksheet though. I'll have to do a video on it later on and just show you. It just sets everything up in a column and it just flows really well. It shows the whole accounting process from beginning to end. Adjusted entries, you journalize them, post them to the ledger, right account. An adjusted trial balance is prepared, so you take your new balances and put them in the right trial. Financial statements are prepared, so this is when you make your financial statements. You prepare them after the adjusted trial balance. And then closing entries are journalized and posted to the ledger. So then you close out everything after you've done your statements. And then you have a post-closing trial balance to make sure everything debits equals credits. And it's a great cycle. And then it goes into breaking down. We could break down every step. But I wanted to get to the fiscal year. So the annual accounting period adopted by a business is known as the fiscal year. Fiscal years begin at the first day of the month, January 1st, and on the last day of the 12th month, the 31st, December 31st. This period is the most commonly used calendar year, but you can use other fiscal years. For example, a corporation may adopt a fiscal year that ends when business activities have reached the lowest point in the annual operating cycle. So, such a fiscal year is called a natural business year. At a low point in its operating cycle, a business has more time to analyze the results of operations and prepare financial statements. So an example would be for retailers, Black Friday is when businesses that are in the retail business actually don't have a loss. Because some businesses during most of the year have loss, but then they make it up for it in a few months of the end of the year, where all those months of loss, they actually make profit. That's why it's called Black Friday, because they're not in the red. They actually made it into the black. They actually made income. And so some businesses only have certain months when they make all the revenue, and it makes up for all the rest of the year. Not every business month after month makes good revenue. It's kind of funny that way. So then we'll do some financial analysis and interpretation, working capital, and current ratio. So the ability to convert assets into cash is called liquidity, while the ability of a business to pay its debts is called solvency. So we have two financial measures to evaluate that. We have working capital, which is the excess of current assets over its current liabilities. So working capital equals current assets minus current liabilities. Current assets are more liquid than long-term assets. Thus, an increase in a company's current assets increases or improves its liquidity. An increase in working capital increases or improves liquidity in the sense that current assets are available for uses other than paying current liability. That's important. It's good to have a positive working capital. The current ratio is my personal favorite. It's a little bit better than the working capital. Um, the current ratio is another means of expressing the relationship between current assets and current liabilities. So the current ratio is computed by dividing current assets by current liabilities. So this gives you a ratio. So if let's say we have $7,745 in current assets, divide that by 1,390 in current liabilities, it'll give us 5.6, rounded up. That basically means for every $5.60 in current assets we have, we only have $1 in current liabilities. You see how that's a good ratio. So we own more than we owe. That's always a good stuff. That's always a good place to be. Let me see. Okay, here we have an example of Electronic Arts and Take-Two interactive software. So Electronic Arts in 2009 had working capital of 1,984, and Take-Two only had 274. So these, you can tell Electronic Arts is a lot bigger, but Take-Two is a lot smaller. So it's kind of hard to exactly compare these two, but the ratio tells a lot more. So the ratio, so the working capital doesn't tell a whole lot, but let's say the current ratio. The current ratio for Electronic Arts declined from year to year. So it went from 3.02 to 2.75, or 0.27. It's also the same for Take-Two's decline from 1.98 to 1.77. So both companies experienced a small decline in their liquidity from 2008 to 2009. So that shows it's never good to have a decline in your solvency, because people get a little bit worried if your business has a lot of debt but very little assets to back it up. Because if for some reason you need if for some reason you have to pay your debt all at once, it's good to know that you have the ability to pay all that debt off and still have capital left over to keep operating. That's all that means. You don't want to have a business where you have so much debt but not enough assets to cover that debt in case that debt gets called or you need to sink it. So it's very important to at least keep maybe a 50-50 ratio. Keep at least half you owe, half you own. So this was chapter 4. It was just pretty much completing the cycle. I just wanted to sum it up in a lecture, but if you have any questions, feel free to ask. I just wanted to get through the basic topics once again, because I can do some examples at a later period. But yeah, just remember that this is a closing process now. And personally, I use QuickBooks, and so when I do it closes entries for me, but I still have to do the entry because it'll automatically close out my expense and revenue accounts, but I still have to take that revenue and disperse it. So me and my wife and I are on the equity statement, as I have Alex Young Capital, Melissa Vasquez Capital, and so QuickBooks closes it out to the retained earnings, which is like the income summary holding, and then I have to go in and make an adjusted entry to see how we're going to divide that income. And so I always say, when you're married, do 50-50, but you can always round the penny up to yourself. So it's good to know how to close, because you don't want to mix one month's revenues with another month's. You got to keep them separated. That's why dates are pivotal. Always, if you're going to do a transaction, record the date. The date's almost more important than what account you're affecting. So make sure you keep it organized. Remember, the post-closing trial balance is only the balance sheet accounts. And so remember, the accounting cycle goes from journal, ledger, unadjusted, adjusted, post-closing, and then financial statements. So that's the proper procedure. You're always going to have your normal transactions for the month. You're going to have your adjusting process. You're going to have your statements, and then you're going to have your closing process. So don't forget that. That's the big picture. These first chapters are just big picture. So feel free to ask anything. Maybe I can explain. So thank you, and I'll see you for chapter 5.